Shenkman, joined by the illustrious Jonathan Blotmacher and the illustrious Robert Keebler. And I hope they'll straighten me out about this topic because I'm finding it more than a tad confusing and complicated. Jonathan, what's going on with the 237s? We just had the Joint Committee on Taxation release its Blue Book report, and what every practitioner should hopefully now have memorized is footnote number. Bob, what footnote are we memorizing?
102.
102.
Okay. Jonathan, can you translate? You know, I remember listening to, yeah, maybe you could translate what it means in English.
Let me give a little bit of background. There was a congressman named Pease who decided that deductions that reduce taxable income for wealthy people was too much. So he basically said when your income goes over a certain level, you're going to basically lose part or all of your deductions. That expired a few years ago, but it's been put back into the law. And it really has very far-reaching effects because it means that, you know, you incur an expense, expect to be able to deduct it, and it's limited or cut back, and therefore you wind up paying more tax. An area where it's really problematic is with trusts and estates, because this provision now applies to trusts and estates. It's section 68 of the Internal Revenue Code. And basically it says that once you get into the top tax bracket of 37%, which for an estate or trust is only $16,000 of the gross income, you wind up having this haircut take effect and you lose 2/37, which is about 5.4%. And that means if you think, well, I've only got a certain amount of income, you may have a lot more income because of this 2/37. And again, for an estate or trust, it kicks in at only $16,000. And that's a very big problem for people. And it's going to be a big problem for us practitioners and trust administrators as well. And basically what's happened is that the footnote that just came out in the Joint Committee report, footnote 102, as Bob has pointed out, basically says that you're going to have to cut back your deduction. Now, it doesn't apply to everything. It just isn't clear. And the language in section 68 isn't clear. And the committee report, which just came out, says that, well, you've got to take a look at other sections as well, like section 67E, you've got to go ahead and do it. But basically the bottom line is that you're going to be limited in your deduction, and that can be especially problematic for estates and trusts. For example, you have a trust which says, pay the income to charity. Okay, you think, well, okay, I'm going to pay the gross income to charity. Section 642C says you get an unlimited deduction for gross income paid pursuant to the terms of the governing instrument to charity. Well, you think you've done that. But the problem is that this report indicates that the section 642C deduction is one of those that is going to be cut back. So if you have more than $16,000 of income, which many estates and trusts do, you're going to go ahead and begin to lose the benefit of your deduction. Basically up $1 million, and Bob, you can correct it, but you're going to lose about $50,000 of tax because of this provision. It's not very good at all. And again, for an estate or trust, it kicks in at only $16,000. It's something that you really need to think about, and it could have, you know, a lot of ramifications, which we're just beginning to think about. For example, there's a QTIP trust that says pay all of the accounting income to the surviving spouse. Okay, I'm going to do that. But I expect all of that income now to be shifted from the trust over to the surviving spouse. But that's not going to happen now because of this 2/37 cut back on that deduction. And the question is, who pays that? And if it's being charged against accounting income, is the widow or widower have a complaint saying, well, you did not pay me all of the income? And could the IRS even come in and say, oh, you're required to pay all the income, you haven't done that, and somehow you're going to lose, you know, the ability to have that count for tax purposes. It's a very disturbing thing. We've spent a lot of time looking at the exact words that are in the footnote and the exact words in the code and the regulations, and it's just not clear. I believe that there is certainly grounds for the Treasury to come out and say, we're going to clean this all up. We want, if you're paying your income to a beneficiary, that income should be shifted. You shouldn't be limited on it. And then you get into the question as well, if they take the opposite position, do you have to adjust things in the trust and the beneficiary? So, sometimes courts say, well, if we literally apply the code, we get an absurd result. And so we have to make an adjustment between the accounts in order to make things consistent with what fairness under state law would be. The leading case on that is called WARMS, W-A-R-M-S, which is a New York surrogates court decision decided many decades ago. And one of my former colleagues at Millbank wrote an article called An Unremitting Diet of Worms. And that was his tenure piece when he went out to teach. So that's more information than you probably want to know, but it's a complicated area. And I've written a wonderful article, which Marty and Bob will soon get from my assistant, Lisa Santiago, entitled The Tax Effects of Equitable Adjustments and Internal Revenue Code Odyssey. It's, I've written about 700 detailed articles, and this is the one that I think is one of my very best. So Bob and Marty, keep it under your pillow at night. It will make you happy, I promise.
I can't wait, Jonathan. I don't think I'm going to sleep until I see it. I think we need to talk a little about what this is, because as you've explained, this goes well beyond just losing a tax benefit. You have questions of fairness under the trust because different beneficiaries could be affected differently, potentially losing a QTIP deduction if you don't make the right distribution, shades of 2519. I mean, that's really bad. And what are trustees going to do? Because if you have to make an allocation of this cost as to one beneficiary to another, it could be material. Bob, why don't you give some indication of what this might mean over time? Because, trusts can go on for decades. I mean, the compounding effect of this, whether it's allocated against income or principal, can really have an impact. And if there's an option to make an equitable adjustment and not a mandate for how to do it, then the trustee's in the unenviable position of having to figure out what to do with all that.
Sure. And under the Uniform Trust Code and the Uniform Principal and Income Act, an equitable adjustment is designed to make things fair when the tax results vary between beneficiaries. That's the concept. And it's going to depend on the document, and it literally varies from state to state depending on the case law and the statutory construction in those states. Now, what we've been dealing with for years is I have 100,000 of D&I, I pay, or fiduciary accounting income more appropriately, I pay that to the surviving spouse, and if that takes all the income out of the trust, Marty, the trust has no income tax to pay. It's nice and clean. The remainder beneficiaries are not harmed in any way. And if that was $100,000 of dividends, the remainder beneficiaries, of course, are going to see the corpus is protected, and then they get to keep all the appreciation. That's generally what would happen. Now, under the new law, what's going to happen is for every $100,000 of income that's distributed, the D&I deduction under, in this case, 661 or 651, if it's an all-income trust, would be pared back by 2/37. So simplistically, let's go through this. If the distribution to the wife was $370,000, she receives that in cash, Marty. The trust only gets a deduction of $350,000. We've manufactured $20,000 of extra income. In the case of 100,000 of income, the D&I deduction would be $94,595. Don't worry about all the specifics. It would generate income tax of $2,000. Now, here's the question. I want to set it up. Jonathan, you're representing these angelic stepchildren, and
Yeah.
Marty, you're representing this wonderful second wife, okay? But they don't get along. And,
Really?
And Jonathan's clients come to him very upset that the trust had to pay income tax on that extra income and that they had to sell stock to make that happen. It came out of corpus. There's no doubt it came out of corpus. And that's probably not right. And Jonathan would argue to a court that, wait a minute, we need to cut back the D&I, we need to cut back the distribution to the spouse to make up for the fact that the income tax is going to be, extra income tax is going to be paid at the trust level. And you would argue the document says all income. And Jonathan might further argue that, wait a minute, we have to take into account a reduction by the income tax attributable to that ordinary fiduciary accounting income. So what will probably happen in time, and let's start with a family trust that is not a QTIP, just a family trust that's not a QTIP.
Like a credit shelter trust.
Like a credit shelter trust, all income to my loving wife. And what would happen in time is the trustee would determine you're going to pay out about 97% of income so that you can keep enough in the trust to pay that income tax. And whether that's fair or not is something we're going to have to figure out over time. That's,
I guess the first question, Bob, is on whom is the tax imposed? Is it on the income or is it on the principal? And, you know, different courts might come out different ways on that, and it might turn on the exact language used.
In the trust document.
Yep, fiduciary accounting income can vary from jurisdiction to jurisdiction and document to document. So it's going to be very, very difficult to determine.
Let me just explore that for a second with you, Jonathan. First of all, nobody imagined this concept because it's hard to even understand the logic, if there is logic, in having a distribution treated as an itemized deduction. And we never contemplated this. So it's certainly going to be difficult to imagine how somebody could have contemplated this change when it's contrary to what the law has been for as long as we've all practiced. So that's one issue, what's in the trust document. And we have to start thinking about how we may want to change what's in the trust documents going forward. Certainly for the example that Bob gave of a non-marital trust where I'm not having to qualify for a QTIP by paying out all income, and that's worthy of separate discussion, I may want to give the trustee more flexibility than I had in the past to make adjustments that they deem to be equitable. So one is the language in the trust. The second is if the trust isn't clear on it or is silent, how do they define under state law principal income and how you allocate those deductions? Is there a power to adjust? Do we adjust for this? What are the parameters for that? What does settler intent have to do with this? Let me ask you a question, Jonathan. Let's change Bob's example of a credit shelter trust a little bit. Let's say the credit shelter trust did not say pay all income to surviving spouse, but rather is a discretionary sprinkle trust so that income could be paid to the surviving spouse or any descendants. Very common structure. And an independent trustee holds the power to make that distribution. How would you evaluate that now? Because everything's discretionary.
Well, Marty, I'm not exactly sure what you mean. Everything is discretionary.
The
but,
trustee
you know,
can make any discretionary distributions
Okay,
in the class consisting of spouse and descendants.
Right, and so the trustee gives, say, the children $100,000. And when you take a look at this is a discretionary trust, so we're under section 661 and 662. And it basically says you get a deduction for the amount of distribution up to the extent of distributable net income that is there. So you pay that $100,000 and you would expect $100,000 of income to shift from the trust over to the beneficiary. But the problem is that now you're going to be stuck with this limitation of the 2/37 if it's an itemized deduction, which This committee report suggests, or the joint committee report suggests that it is, then you're going to have to not get a full deduction for it. So even though you paid out $100,000, and by the way, Marty, it may be that they have $100,000 of income, but they just don't get, the trust just doesn't get the benefit of the deduction. So you now have a real mismatch. You've now created income where there wasn't any before. You might have been better off just leaving it in the trust and paying the tax in the trust rather than having it tried to shift over to the beneficiaries. This is going to cause real problems in administration, Marty. I envision. Maybe I'm wrong, but I think it will. What am I supposed to do? Do I lend instead of making a distribution? What if I want to make it later? It's a real problem.
What do you think a trustee is going to have to do? Let's say it's the credit shelter trust and they're giving the income to the surviving spouse. And because the spouse wants the income, they're paying 100% out and the tax cost is coming out of the principal.
Well, I don't know if it's coming out of the principal or not. That would be determined by the terms of the instrument, state law, maybe a court order. Very tough to know what it is. We're in a new area.
Let me ask you a question, but forgive me, Bob, one last question. If the trust document says, the credit shelter trust that we're talking about hypothetically, this illustrative trust, that the trustee should favor distributions to the spouse over other beneficiaries, would you interpret that to suggest that if there's $100,000 of income and you're going to pay the $100,000 to the spouse and allocate the difference because that's what settler's intent was?
What do you mean allocate the difference?
In other words, if there's $100,000 of income and the trust expressly says to favor the spouse over the descendants, then the trustee gives the $100,000 of income to the spouse, but only gets like a roughly $97,000 deduction, with the 5.4% haircut. That difference has to be paid the tax out of the principal. But so I'm adding one new fact. If the trust says you have to favor the spouse over the descendants, would you infer that to mean anything about this?
Well, Marty, first of all, I've never had a trust which said you must favor the spouse. Typically, it's
recommends it.
Yeah, but and let's say that it's recommended, and the trustee says
in the ILS language, there's a provision to recommend that.
That's right, and let's say that I'm going to recommend it, and I go ahead and I say to the spouse, I got 100,000 of income. I'm going to give you the 100,000. Now again, she may have 100,000 of income, but the trust isn't going to have 100,000 deduction if this provision can be read as the joint committee report suggests it should be. So, you're going to have a situation where somebody's going to owe that tax. And the question is who bears it? And that brings up, what Bob raised before, which is equitable adjustments. And we just don't know. But it's something that's going to have to pay really careful attention. And I have a feeling that we're going to have to change the terms of governing instruments. We're going to have to get state laws changed in order to be able to cope with this. It's really problematic. One thing we say, well, we're going to shift the income over. And one of the things that can be done, Marty, is to say, well, we're going to give the surviving spouse a withdrawal power under Section 678 of the Internal Revenue Code. Because if the beneficiary is entitled to a distribution, no limitation on it whatsoever, not income, but it just says pay this much to the beneficiary, that under Section 678 will make it a grantor trust with respect to that portion for the beneficiary. And that income is then allocated to the beneficiary. The problem is, I'm not sure you can do it mid-year. It may be that you have to do it before the year begins and say, we're going to pay you, Mrs. Smith, $100,000. Now, whether it can be a formula, whether you could say, well, would have been accounting income, nobody knows. These are all new areas. And different people, I think, would come out in different ways, and it will be very problematic.
But using a 678 trust approach may circumvent the loss of the D&I deduction by getting the income to, say, the surviving spouse. That may not be what's intended. Going back to Bob's example, second marriage, surviving spouse, and kids from a prior marriage, and they don't get along, which they usually don't. So now you have a conflict. Giving the surviving spouse instead of a sprinkle power is between the spouse and benefit descendants held by an independent trustee, you now have given the second spouse, the surviving spouse from the second marriage, the right to pull it all out.
Yep.
That's, it's like kind of from the frying pan, the proverbial jumping from the frying pan to the fire.
Right.
Well, and let's circle back to the QTIP for a minute. Obviously, 2056B7 uses the term all income. We know that. So if I make an equitable adjustment and reduce what goes to the surviving spouse in a QTIP, obviously there's a question of whether somehow we would endanger the QTIP election itself. There's a question of,
if the instrument is clear, and one of the things that I do in the ILS documents, so is say, pay all the income within the meaning of, the regulation, which is, 20.2056-7, and make sure that you really mean it. But again, you can have equitable adjustments where everything that would be income, say in New Jersey, is not income in Wisconsin. So you may have some disparity there. But the courts have accepted that those differences can exist, and it won't cause you to lose the marital deduction.
But you're now creating a complexity for practitioners that there can't be one generic answer that people use, because it's going to be specific based on what you put in the trust and specific based on state law.
That's right.
If state law definition of fiduciary accounting income, which is the definition of income for what has to be distributed for the QTIP, if it reflects that expenses for that income, like income tax, can be applied to reduce fiduciary accounting income, would that then avoid this issue, because it would automatically, if you will, in the calculation be charged against the surviving spouse in the QTIP?
I think so, Marty. I think, the regs are pretty detailed. They don't get into that, but where there's a charge, it's going to be charged against accounting income. It just reduces accounting income. It reduces what the surviving spouse is supposed to get. Again, you've got to be.
And isn't that, I'm sorry to interrupt, but isn't that economically the same to the surviving spouse? Because if the surviving spouse got 100 grand of income and paid income tax because of the full D&I deduction, and now gets 97 of income and puts 97 on his or her return, isn't it probably net, if they're all in the maximum bracket, the same?
It probably would be, but they're not always going to be in the same bracket, and they're going to be in different tax jurisdictions.
Right.
Very, very tough to know.
Do you think the committee understood the magnitude of complexity they were creating with this?
I'm confident they did not.
Because this is tough.
To make it slightly worse, there's also an issue of conformity in that some states will not have picked up this 237th adjustment. So as you do your state fiduciary income tax returns, you're going to end up with reconciliation items between the two. But Marty, we kind of talked about this in the context of a family trust and a QTIP. Why don't we go in the slides and just look at some other situations? I'm very fascinated to hear what you and Jonathan have to say about the charitable issues.
On a large charitable trust, you're reducing the deduction, and it's going to erode principal, which over long periods of time is going to have a meaningful impact.
Well, it certainly will, Marty.
But I see this all the time.
None of this was contemplated when those trusts were created.
No, not at all.
What do you do, Jonathan?
Marty, maybe you have to go to the court and ask the court, what do I do here? And sometimes, courts will give you guidance as to what you should do. Other times courts say, well, you make your decision and then come before me and we'll see if you've committed a sin, and if you have, what penance you have to pay in order to cure that. Very, very scary.
And the fiduciaries are in the hot seat.
Absolutely.
If you have a charitable lead trust that's for 25 years, over 25 years, wouldn't it be, Bob, some material erosion of principal if you're taking out that 2-3% a year, year after year compounded out of the principal?
Very much like the example I put together with the QTIP. And you are going to lose. So anyone designing and trying to implement a non-grantor charitable lead annuity trust today is going to have to make sure they, in their model, they take into account that they're only going to get, if the payment to charity each year was 370, Marty, 370,000, the deduction would only be 350,000. You have a $20,000 variance, call it a tax rate of 40% for easy math. That's $8,000 a year that is not going to be available to the remainder beneficiaries because it's left the trust to go to charity.
But it's 8,000 per year compounded over a lot of years.
Right, with growth over 20 or 30 years. I mean, if you look at that, it's going to be a meaningful number. The important thing right now is for anyone planning to do a non-grantor charitable lead annuity trust this year, their model has to show that to the client because this is now very real.
Jonathan, would that suggest doing a grantor clat instead of a non-grantor clat?
Well, it may, Marty. I mean, there are obviously lots of consequences of that. Remember, individuals are also subject to this Section 68 once their income gets above a certain level. It's very difficult to say what is best and what should be done. I think it's just too hard for us to figure it out. I'm hoping that some of the groups like the AICPA and the American College of Trust and Estates Council who have written to the Treasury about this, I hope the Treasury will listen and it will come out and do something. The committee report, which just came out, which we've looked at, isn't perhaps that accurate. It says certain things, but they've made certain assumptions in their construction. And maybe they will come out and say, no, this is a mistake. We didn't intend for things like the 651 and 661 distributions deduction to be caught by this rule. I just don't see any reason why it would be. But again, what I think and what the Treasury does can be entirely different, obviously. And Bob, you have here, the estate tax, the deduction for income taxes for estate taxes paid under Section 691C. That's going to be a problem for a lot of situations. And this could happen, with respect to qualified plans that go into trust, because, you're going to want that full 691C deduction and you may not get it because of new Section 68, at least as the committee report suggests.
Bob, I don't want to put you on the spot, but could you maybe just talk through a simplistic example to illustrate what Jonathan just said about a large IRA in the tax?
Well, if it applies, a large IRA could get you in trouble two places. One is, I just reviewed a document for a $17 million IRA payable to revocable trust, and then on to charity. And let's just use 3.7 million for easy numbers. Marty, that 3.7 would potentially come out of the IRA, go on the tax return, be taxable, and the deduction would only be $3.5 million. So we'd be leaving $200,000 on the table, subject to tax, call it 40% for easy math, $80,000. There'd be an $80,000 haircut. Now, the way around that would be to route the IRA directly on the beneficiary form to charity, or before the trustee takes the money out of the IRA, we would do an in-kind assignment of the IRA to charity. And I've had private letter rulings on that. There's a good dozen private letter rulings that allow for that. So that can be solved.
Can you explain that just quickly?
Sure.
The concept.
If you take the money out, it used to come onto the tax return and then be washed out if you had the right magic language in the document to pay IRD to charity. The assignment, the trustee doesn't take the money out, and he or she tells Fidelity or Vanguard or Schwab, give this to my favorite charity, still in the IRA wrapper, and then let the charity unwrap the present when it gets there. And they wouldn't pay income tax. That's the beauty of that planning. But we're going to have to pay very close attention to this. And it's just going to have to be very methodical. And I think what's going to happen is it's going to be incumbent upon the lawyers administering estates to very early in the process get the CPA and lawyer in the same room and just lay out how many ways this could go and what's the best solution.
And there may not be best.
There may not be a best solution, but at least try. Now, if this applies, if the 237th adjustment applies to 691C, 691C is the income tax deduction for the estate tax paid. So I die with a very large IRA. I have 15 million of land and a $10 million IRA. The entire IRA is subject to 4 million of estate tax. Up until today, or up until the 6 months ago, you would have said 10 million minus the 4 million of estate tax, you pay income tax on $6 million. The question is today, do we have to give that $4 million deduction a 237th haircut? And that will tell. Now, it doesn't look like it applies to 199 Cap A. And there's a little bit of an open issue of whether it applies to 691C. So, but if we raise these issues, it gives practitioners a chance to get ahead of it. Now, Marty, there's no good time to bring this up, but I'll bring it up. This applies, and you have that in your materials, for years beginning after December 31st, 2025. So let's say somebody died on December 15th, 2025. Their CPA almost undoubtedly, I think 80% or 90% of the time, would elect a fiscal year, and this doesn't apply then until December 1st, 2026. So we buy a year. Now, why is that important? That's important because it's something that you and I identified early, and that's that daisy chain effect. Maybe we should, at some point in time today, talk about that.
We only actually have another couple of minutes. Jonathan, I know, has to leave, but if you want to, before you leave, Jonathan, why don't you make some concluding comments? Then we'll have Bob finish his comments on the daisy chain, and I think we have to do another program, and we have to write an article. We got to figure more of this out.
Well, right, but people are looking at this, and the Joint Committee report, which just came out, has thrown another wrench into the works. So I don't know. It's going to take time. I'm hoping that the Treasury will do the right thing and straighten this out, because it's going to be horrible for everybody. Keep in mind that the Treasury is given no money or allocates no money for the audit of fiduciary income tax returns, and that's where this is. And to think that regular agents will be able to handle this is just ridiculous. But guys, as you know, I've got to go. Good luck, and it was fun. Thanks, men.
Thank you, Jonathan. Bob, why don't you explain the daisy chain concept? We'll cover a few more points and then wrap up.
Well, do we have a slide on the daisy chain? I think you built one.
Hang on.
So
you want to go through this first?
Sure, we can go through these illustrations. So just so everybody understands, if we started with $1 million, in the past we would have taken and we gave that all to the spouse, we would have got $1 million deduction. Now today we have to take a haircut. That means the deduction is only going to be $1 million minus the D&I deduction, $1 million minus the $54,000. Now that's going to leave you with income at the entity level, the estate or the trust, and that will result in that income tax on basically phantom income, Marty. We haven't used that word yet, but that's exactly what we have. So that's the first concept, is you're going to have phantom income. And we talked about under the trust provisions, under the Uniform Trust Code and under the Uniform Principal Income Act, do you make an equitable adjustment to make up for that? Let's go to the next slide. So now basically, if you have no offsetting, what happens is depending on how many levels of tax you have, the rate keeps inching up. And interestingly enough, Marty, what happens is, let's just say that I died and everything went, I had a beautiful revocable trust, just like many wealthy people would have. It's artfully drafted and it breaks into a family trust and a QTIP. And both the family trust and the QTIP then say all income to my wife. So we start with
Very common approach.
this is a very common approach. So we start with a D&I deduction between the revocable trust and the family trust. So I have that administrative trust. It transfers its income to the family trust and the QTIP when it makes its distributions. And there'd be a haircut at that transfer. And arguably there'd be another haircut when my family trust goes ahead and makes a distribution to my wife. So in the past, it would be $1 million would go from the revocable trust to the other two trusts, and my wife would report $1 million on her return, and the revocable trust and the family and the QTIP would have no income left. Everything would wash out. It'd be like a conduit, okay? Now what's going to happen is we have to cut that $1 million twice by 237s. So we're basically going to come out where the deduction is reduced from $1 million to roughly $940 some thousand, and then again reduced to somewhere around 880 or 890. And I'm not worried about the math. I'm worried about the concept. And that concept, Marty, pushes up the rate. Now, where this really gets interesting is when we have an estate, and the estate then pours into a revocable trust, who then pours into a family and a QTIP. And here's what this says. What this says, at least for the dozens of estates I'm involved with right now, we want to use fiscal years, A, and that buys us a little bit of time. But B, we may want to do our funding, moving the property from the estate to the revocable trust very, very quickly, as soon as the probate court would allow us to do that. We also may want to take the revocable trust and start to fund the family trust and the QTIP early in the administration, so that there's less D&I that transfers from the administrative trust to the family and the QTIP trust. And
is that what you're referring to, Bob, as the daisy chain? Because each of those transfers, you're going to end up with a haircut?
exactly, that's exactly what my observation is. If indeed footnote 102 is correct, you'll end up with a daisy chain.
So what that would suggest is the very common concept of creating a standby revocable trust is really not the way to go. The revocable trust should be fully funded, because then without probate, you may be able to start funding whatever trusts are provided, whether it's a credit shelter and a QTIP. And the complexity is going to even be greater if you have a second QTIP with a reverse GST exemption. You know, can you then allocate the haircut only to the non-GST exempt QTIP for both QTIPs?
Yeah, those are going to be the questions. This is, you know, the proverbial spider web. The further we get into this, the more complex it's going to get. So basically, you know, what you're illustrating here is this daisy chain effect. You had a nice slide you put together, which kind of showed it horizontally from left to right. I was impressed by that. That was a good slide. But you can see how the rate just keeps increasing. Let's go up one more slide, Marty. There it is. So again, I want everybody to just think of a probate estate you have right now that pours into a revocable trust. When you move from the box on the far left, the estate, into the administrative trust, there will be a haircut with regard to the income earned at the trust level. In this case, Marty, you showed $1 million of income, and there'd be a $54,000 haircut. Now, when that moves to the administrative trust, it doesn't lose its character. That stays fiduciary accounting income. It doesn't magically turn into corpus. So it has to then be passed to the QTIP, and then it has to be passed to the surviving spouse. In this case, you'd have this daisy chain, and that seems like a terribly unfair result.
The complexity is daunting.
And this just shows some of the math here. But, I don't want to get, I'm more interested in talking about the concept, because we'll slow down if we try to do too much math, but it's really important to look at this.
Yeah, what is fairness, Bob?
Well, that's the interesting question. And let's just take an estate that says, I die and I leave $3,700,000 to my favorite charity and everything else to my children. And the charity certainly would seem to be thinking it's going to get $3.7 million, right? But my children say, wait a minute.
Don't take that haircut from us.
Yeah, don't take that haircut from us. We're supposed to get the residue. That haircut cost us 80 grand. Now, in many families, the children might say, so what? It was my dad's favorite charity. We'll live with this. But Marty, in a certain percentage of families, there'll be disagreements, and there'll just be some issues that have to be worked through.
When you gave your earlier example of the surviving spouse from a second marriage, kids from a former marriage, and they don't get along, I mean, all the family dynamics that come into play, and then you have these adjustments for the haircut that are inherently not intuitive. I don't think any layperson is going to understand them. I think we as practitioners are already struggling and are going to continue to struggle. So yeah, you don't know what the proverbial straw that'll break the family's camel back, so to speak, would be to create a feud. Bob, you raised another issue. So let's say there's a QTIP and the income goes out to the surviving spouse because that's what the instrument says, state law says, or that's how it's interpreted, whatever. And the principal comes out of the tax is paid, the haircut tax is paid out of the principal. Is that a gift by the remainder beneficiaries to the surviving spouse?
Yeah, you have to go back to, I have it here, Marty. Remember at the end of 23, there was a CCA issued, and that was CCA 2023-52018. And that said that if you had an IDGIT or a grantor trust without a reimbursement clause and you added a reimbursement clause, it was a gift from the remainder beneficiaries to the life estate or to the grantor.
To the father that got the tax reimbursement.
Right.
Even though no one knows how to measure it.
Right. So now along come the children and they say, Dad, we love you. We know you need this money. We're gonna go along with an equitable adjustment. And
meaning specifically that the tax for the haircut is paid out of the principal, not out of Dad's income.
Yeah, the kids say, Dad, we have this. And I think, if it's all common children to the mom and dad, mom died, dad's the survivor, that's probably what I would see most likely to happen from my experience.
But not in every case.
But not in every case. And then, do we run into that CCA?
Yeah.
So
this is like an onion. Every issue you raise, there's another layer underneath it.
Right. And remember, we talked about 642C, but here's the thing in the short term, Marty. The 642C issue, the first thing you'd have to do is anything you're putting together right now, any charitable, non-grantor charitable lead annuity trust, any estate plan that involves a charitable bequest, wrap your mind around how this is going to impact it and see if there's a workaround. Like a workaround, Marty, a lazy workaround, if feasible, is if I wanted to leave $3.7 million to charity, I might just do that through my IRA. And I know we have the Kennan issue. Natalie Choate, I believe, has expressed her opinion that Kenan probably doesn't apply to IRD for a number of reasons, but if you can get comfortable with that, you could just leave an IRA worth approximately $3.7 million to charity, and then say, I leave $3.7 million to my favorite charity, less the amount that passed under my IRA, and you backfill through the estate. You could also assign that IRA, once it's in the estate, to the charity, not triggering income tax, and you get around these issues. But these issues need immediate attention. And it's really, and we've talked about this a lot. I think we have to make sure, and for the financial advisors listening, please show a lot of leadership here and get the lawyer and CPA in the same room and let them solve this issue, okay? This is a very complex issue of the tax code and the uniform trust code, and it needs immediate attention. And that attention should probably begin within 6-8 weeks of when somebody dies, because it's going to take a while to figure this out because it varies from state to state. Oh, go ahead, Marty. I see you have some great questions up here.
So what do you do as a trustee? I mean, I think the first thing you have to do is read the trust instrument with an eye to what you can or can't do, because this is not something that was on anyone's radar when any trusts were drafted. So can you hold back cash to pay the tax? You know you're going to have to pay the tax. If there's multiple beneficiaries, and as Bob and Jonathan were explaining, I mean, the interests of the different beneficiaries or groups of beneficiaries could very well be at odds. What do you do? And what do you communicate to the beneficiaries? Because you don't want somebody coming back years later and saying, hey, for the last 5 years, you were paying the income tax on the income distribution to my stepmother out of my principal. You got to think about what you want to communicate as well. Go on.
If I'm the trustee, I try to get in front of a court, and I brief this issue for the court, and I encourage the other side to brief it, and I let the court help us through this.
The practical problem with that for many of the people that are going to be affected, this is not only something that affects very large trusts and very wealthy estates. This is going to affect lots and lots of people, and the cost of going to court, not to mention if it's all public record, even for uber wealthy people, the publicity, it may be far more of a concern than the cost, but you have to deal with both the cost and the potential public record information. A lot of people are not going to want to do that. So then maybe what you do is you have some sort of acknowledgement by the beneficiaries of what's being done.
Right. In a first marriage, everybody probably just signs off, right? It's going to be a second marriage where it could become a little bit more difficult, but it depends on materiality, Marty. If this is $37,000 and you lose $2,000 itemized deductions, it just costs you $800.
It's not worth it.
It's not worth it.
But I would still, if I were the fiduciary, want to inform the beneficiaries of the potential differing treatment and what we've done and why. I'd like to at least document why I did what I did so no one can come back later and argue. In fiduciary cases where fiduciaries have left money sitting unproductive in a checking account for too long or too much, even if the numbers aren't that large, the courts have tagged them and used that as an important factor in assessing whether or not they've carried out their fiduciary duty. I'd want to make sure that there is something in the trust files addressing this, and that needs to be given some thought. We have no idea how the Treasury will do this. I think, and Jonathan kind of suggested that maybe they'll take a different view. When I think the complexity and the ripple effects that this all can create, that may well be something that might encourage the Treasury to back off from what the Joint Committee on Taxation said in footnote 102, because if they're going to administer this, what kind of resources are they going to have to put on something like this? If this reading is considered to be beyond what the logical reading of the statute and the changes in OBA are, maybe there'll be a Loper-Bright challenge.
Well, and if that means we have to start thinking about protective claims, Marty. So
It just keeps going on, doesn't it?
it's very complex, but under the Loper-Bright theory, it'd basically be, did the Treasury have the authority to take this position? If they did not, then what we would do while we were waiting for somebody with a large amount of money to litigate and solve this issue, we would file a protective claim, taking the position that, and this is for the CPAs listening, you would get a first-class litigator involved who would help you craft that protective claim, and you would try to sit on the sidelines and let some very, very wealthy family pay for the litigation, and then hopefully you would be able to follow suit. And the IRS, if the IRS loses that, maybe they acquiesce, and then you can file an actual claim. But in the meantime, your protective claim would keep that statute open. Generally, recall the law, 3-year statute of limitations.
I think we've covered most of this, Bob. Do you want to make some concluding comments?
I think what's important here is CPAs should, you basically, if a good client just died, some of these problems are going to exist. You and the lawyer administering that estate need to sit down and start to work through these numbers and do pro formas, build Excel spreadsheets, show how this is going to work mathematically, and just be very supportive of the decision process. Now, you're probably going to take a haircut on legal, CPA, executor fees. We have this D&I issue, which is the heart of what was a spin-up from that footnote 102, Marty. This issue of equitable adjustments, I think if a CPA is asked to do that, we just have to really wait for the AICPA's TRP committee to give us some guidance. But it's probably not my place to make an equitable adjustment without either a court direction from the court or an opinion from a lawyer which says state law would allow for that. Between the document and state law, you can do it. And then Mr. or Mrs. CPA, go do the math. Make the math work. This daisy chain effect, Marty, it says quick funding may be the way to go to minimize that daisy chain. Okay, because that's going to be a painful experience. And then you brought it up and Jonathan brought it up a little bit, but I want to leave everybody with one final thought. In the drafting stage, for somebody that's sick right now that may pass away, think about whether you could make that bypass trust a grantor trust with regard to the wife by giving her a 678 power to withdraw all income.
I just don't see that happening very often. It's a great theoretical, it's a fascinating theoretical idea, but it's going to be contrary to what a lot of people want to do. And the complexity of that is daunting. I do think, just to conclude, that practitioners may want to start thinking about putting some language in their trust documents that give trustees flexibility to make, economic adjustments, equitable adjustments where the trustee in reasonable discretion thinks it's necessary, and add a strong indemnification for the trustee so they don't get in hot water trying to just do what's right.
Totally agree.
I think all the allied professions are going to be spending time on this, unfortunately, because it's complicated, it's unclear, and every time we talk, we come up with new potential ramifications and ripple effect of it. So thank you, Bob. Thank you, Jonathan. And thank you, everyone, for joining us. And please send us comments and email us and call us. And we're all kind of in this trying to figure it out now. Thank you.